Good morning again, dear audience. As I would like to say usual, we offer a keynote speech from EIOPA perspective since the very beginning of the ECFs we have organized. And today it's a pleasure again, because she has done that last year, also via the internet, and today in person. Teresa Moutinho, she is the head of supervisory processes in EIOPA, and I can say we have had a lot of good cooperation with regard to some of the topics which have to be discussed, what can be done for captives or not. I remember especially about the reporting requirements to delete some of the columns and tables which are not 100% necessary for captives. So, Teresa, the floor is yours.
Thank you, and a very good morning to you all. My first decision is if I wear glasses or not. I'll try without them, but if I need them during, please bear with me. I'm very pleased to join you at this European Captive Forum, this year in person for the first time. As Gunther said last time, I could not travel, and I did it digitally. And there are so many areas of interest to captives, and we can see from the broad and very interesting program we have for these 2 days, that it was actually difficult for me to decide what to bring here today as European Supervisory Authority. But difficult decision, but at the end also very straightforward. It was clear for me that I should bring resilience and how to address resilience, how to foster resilience. This seemed the right topic. More and more, resilience is becoming a highly valued quality, be it in organizations or individuals. Being able to demonstrate our capacity to deal with shocks or change is fundamental these days. This is much the same for insurance, a sector that needs to be ready to respond to recover, including captives, many times incorporated in groups with very relevance for our entire economy. I think that for all of us, the term resilience took a new dimension during pandemic. We experienced firsthand the importance of resilience. For all of us, we put our agility and adaptability to the test. And with this, on many different levels, societal, organizational, and also individuals. Indeed, we learned many lessons from the pandemic. And as we are emerging from the pandemic to face new challenges, so we are seeing that resilience can take many different forms. And so, in my remarks today, I will touch upon some of the broad issues that are on our radar and how we can be resilient to face those challenges. Let me start with a few words about Russia's invasion of Ukraine. This is, of course, first and foremost a humanitarian crisis. But we must also be aware of the impact of the aggression on the economic situation and the stability of the sectors where you operate in and that we supervise. From our analysis, we see that there is a very limited direct impact on the insurance and pension sectors. However, second-round effects are becoming increasingly visible for both insurance and policyholders. Inflation is hitting record highs, and the probability of a worldwide recession is becoming more apparent. These new conditions are creating a cost of living crisis for consumers. Once again, people will be faced with uncertainty of their household finances. The subdued economic growth with potential for repricing of risk premia and the persistently high level of inflation with subsequent adjustments of monetary policies by central bankers are shaping a new economic environment of increased uncertainty for financial and non-financial corporations. We are therefore closely monitoring the economic situation and evolution of capital and liquidity of the position of the EU insurance and EIOPS. We will use both our regular instruments, such as the risk dashboard or the financial stability report, as well as ad hoc analysis to continue to monitor the situation, working closely with national competent authorities and the European supervisory community. And so, while Ukraine remains on the very top of our agenda, we also have a number of other issues on our radar. A glance at the agenda of this year's forum shows well enough the topics that are both high on ours and yours agenda. I'm talking about financial innovation, cyber, or sustainability issues. These are all areas that are resulting in profound, some would say disruptive, changes into the insurance sector. But as always, they bring both challenges and opportunities, a very old sentence. Let me start with financial innovation. I think that one of the biggest revelations of the pandemic was how easily we have incorporated technology into all aspects of our life. When we consider the rapid pace of technology development, we can expect this to further impact our life in future. In financial innovation lies one of the biggest challenges we face as supervisors. What is the role of regulators and supervisors, enabling innovation and still ensure protection of consumers? Insurance is a highly regulated activity, and therefore, regulatory frameworks already encompass some aspects of innovation, even if indirectly. Take artificial intelligence, for example. Artificial intelligence can be simple and harmless. You all probably have seen that when entering the webpage of this event, you had a button which says AI recommendations. If you use this button, the AI-powered matchmaking algorithm determines the top matches for you based on the analysis of your interests that you reported when you registered for this event and also your past behavior. This can facilitate the choices for the next 2 days. You had this in your web event. Now imagine what AI can bring when you use big data sets and how can it impact different parts of the insurance value chain. Solvency II and the Insurance Distribution Directive already indirectly cover the use of AI. Then, of course, cross-sectoral frameworks came, GDPR, on data protection that provides a sound use of data. In addition, the European Commission legislative proposal for an Artificial Intelligence Act now being discussed will also bring additional rules on the use of AI, and these will cover as well insurance sector. Here, EIOPA supports the Commission's risk-based approach reflected in the AI Act. Not all AI systems reflect this or pose the same risks, so definitely we need proportionality here. And to be seen what will be the final list to be included in the annex and identified as high-risk uses of AI. The use of AI is fairly well established in the insurance sector. However, there are new trends that I would like to touch upon and that require our attention. And the first one is the platformization. We are seeing new actors, including insurtech startups and big tech companies entering the insurance market, both as competitors and also as cooperation partners of incumbent companies. In the case of the latter, insurers are increasingly turning to third-party providers to gain quick and efficient access to new technologies and new business models. In our thematic review on big data analytics, which has now 4 years, it was on 2018-2019, 2/3 of the insurers that participated in the survey said that they used third-party providers and outsourcing arrangements to implement AI-powered chatbots, for example. And this, of course, brings additional third-party risks into the picture. And, of course, the topic of open insurance. In our case, to be included in an open finance framework. At EIOPA, we believe that open insurance may represent a wide range of opportunities for both consumers and the sector as well. But there is no clear view from stakeholders where to go on open insurance. And this is why at EIOPA we are developing a use case that will help us to identify the real implications of open insurance, take lessons from PSD2 implementation, and try to show us how open finance framework can look like. And this is all in preparation of the Commission proposal that we expect on open finance framework that we expect at the beginning of 2023. We want to be ready to answer that from an insurance perspective. And meanwhile, we are also monitoring other initiatives from the Commission, like the European Single Access Point or Data Act. And many of these acts will impact the industry as well as supervisors in the insurance sector. We want to make sure that the view of the sectors and supervisors are heard in all these projects. All these areas have a common point, data, and the sharing of data. And that's why digital ethics is fundamental. Insurance must be able to explain how their algorithms work and be accountable for their systems, enabling consumers to have access to adequate redress mechanisms. And consumers need to be aware of what is being done with their data, and if they do agree to share data, they must be doing it on a conscious decision. Our consultative expert group on digital ethics has looked at issues like this in the past year, and we have issued a report that outlines key governance pillars for the ethical and trustworthy use of AI. A very helpful step, but not the last one. For sure, we'll need to continue to work on this, and you'll see more from EIOPA on AI on the next year, also depending on the final outcome of the AI Act, of course. So this takes me to other resilience aspect, which is the cyber resilience and the cyber resilience that we all must have. We need to make sure that all data we hold and share is kept securely, and that there is sufficient measures in place to protect against cyber attacks. Indeed, operational resilience is essential for the well-functioning of the financial sectors. The European Commission proposal on Digital Operational Resilience Act, actually already approved, and it was as part of the European Commission digital strategy, sets out a comprehensive framework enabling a stronger supervision of the digital dimensions of the sector. The regulation builds on our work as well as our sister agencies, EBA and ESMA, as it is a horizontal regulation. The proliferation of digital technology across the entire insurance value chain has increased the exposure of insurance to the risk of major disruption if technology fails, either through a deliberate attack or a system flaw. Similar risks can be identified on the insurance intermediaries and also on the occupational pension sector. And this is why we need to have a good regulatory framework in place to ensure proper risk management to protect against cyber attacks and other risks. We have long highlighted the cybersecurity and ICT resilience as critical factors, and we'll now focus our immediate work on the monitoring of the cloud and ICT governance and security guidelines, as well as contribute to the policy work of DORA, the Digital Operational Resilience Act, where a number of technical standards will need to be developed to guarantee its implementation. And please note that DORA applies to all insurance and reinsurance undertakings covered by Solvency II, and this includes captives insurance and captives reinsurers. From a different perspective, the insurance sector can play a role in mitigating the impact of the cyber risks faced by the different players in the economy, facilitating the transformation of the digital economy and reducing protection gaps. Here, captives can play an important role. In case you are interested, there is also a very interesting discussion I plan to attend tomorrow on this exact point. Cyber insurance, on top of risk coverage and mitigation, is expecting to bring additional benefits for clients by promoting good risk management practices of policyholders and increasing their cyber awareness. But we know that cyber risk exposures are under more scrutiny because there can be ambiguity in terms of conditions and regarding the coverage policies. And when there is uncertainty around coverage, there is uncertainty about risk assessment. Ensuring appropriate cyber underwriting and cyber risk management practices and establishing good supervisory practices on this area is also a priority for EIOPA. On this, EIOPA has published a supervisory statement on the management of non-affirmative cyber exposures. And the statements include specific reference to the sound management of policy wording and also presentation of information to clients. The third area of resilience that I would like to touch upon today is sustainability. Let me talk about greening the economy. There is no need for me to talk about the importance of green transformation. It is quite simply what we must do and what we all need to contribute to. It is clear that mitigating risks is no longer enough. For a transition to a more sustainable economy, real change is needed. We need new approaches, we need adaptations, we need a new normal. In general, the insurance sector can deliver all of this. As large long-term investors, they can also channel funds into sustainable investments, ensuring sustainable value creation for the longer term. And I understand for captives this might bring additional challenges. So let me focus on climate change and what must be done to close the protection gaps. We can only close protection gaps if we can fully understand the drivers of the gap. And if we have a full risk assessment that is based on data and expert modeling. In case of natural catastrophes, we have been developing our own natural catastrophic dashboard, which is public, and that in the long term will help us to fully understand the drivers of the gaps and lead to better prevention and adaptation measures. Our research has shown that only 35% of natural catastrophe losses in Europe are covered by insurance. And why is this? Is it because it's not available? Is it because it's not affordable? Is it because the clients, industry, individuals did not understand, they are not interested, or they do not understand the impact of their lack of coverage? Understanding consumer behavior is just as important as any adaptation measure when it comes to reducing physical risk and related losses to policyholders. I'm happy to see that ESG, sustainable finance, and climate change assessment are also part of this forum's agenda, with several actually sessions to attend. To ensure the resilience of our economy and our society, we have to drive the transformation towards the green economy. At EIOPA, we have long said that insurance have an important role to play in this regard, choosing where to invest their large sums, incentivizing policyholders to take steps to better protect themselves against the effects of climate change, and influencing business to operate more sustainably. With regard to Solvency II, European Commission has proposed also 2 mandates regarding sustainability risks, including exploring the prudential treatment of exposures related to assets and activities with a substantial association to environmental or social objectives. We are also pleased to see the inclusion of climate change scenarios in the ORSA on risk and solvency assessment. This is an essential step in fostering a forward-looking management of climate change-related physical and transition risks that will help to ensure the long-term solvency and viability of the industry. But this is only one side of sustainability coin. The second relates to policyholders. Investing sustainably is also complicating and confusing. So we have work to do to ensure that policyholders can take informed decisions according to their own sustainability preferences. And of course, we all know that in case of captives, this can take a different dimension. And we are all working on this. A lot of work is still to be done, as I said, and it's urgent to understand the specific challenges for captives in this area. Before I conclude, I would also like to say a few words about shared resilience solutions. I just heard in the previous session, captives are part of the solution, they are not the full solution, and we need cooperation. It's true. I have talked here about protection gaps and the importance of closing those gaps. This leads me to question, can we insure against all risks? And the answer is no. This is another lesson that we can take from the pandemic. The pandemic, natural catastrophes, or cyber attacks are sudden, with wide-reaching and indiscriminate impact, and they cannot be tackled by a single entity alone. Instead, we need to develop shared resilience solutions that encompass proper risk assessments, investment in prevention measures, appropriate product design, and residual risk transfer. At its heart, a shared resilience solution requires joint cooperation. To achieve this, we need solidarity and shared responsibility across all sectors of society: governments, public institutions, industry, and civil society, with insurance as a pillar in any shared solution, including captives business. As part of our work, we have developed an holistic framework to assess the risk drivers of protection gaps and the options to address these gaps. And looking ahead, we want to further develop it. What I've given you today is a broad overview of some of the topics that we have in our agenda, and now we are looking at them from a resilience perspective. The issues that I have mentioned are valid for the entire insurance sector, including you. But I would also like to say a few words to you as captives. You play an extremely valuable role in the insurance sector, in society, and fostering resilience in the economy. For example, I've just mentioned protection gaps. As captives, you can be part of the solution for some of these risks of the captives owners. This is just one example of the value of captives, but we also need to acknowledge that captives are distinct from other insurance companies, which is why my last point will take us briefly through Solvency II and Solvency II review. Let's face it, Solvency II, as it stands today, do not reflect properly the reality of captives, translating only on a few simplifications in financial requirements calculations. This led to challenges, but also different implementations in areas which are more flexible, like Pillar 2 and even Pillar 3. But review underway will hopefully change this reality. The Solvency II will bring new light to captive-specific business model and proportionality in general, actually. Proportionality is key to ensure more adequate approach to supervision. And in this respect, we welcome Commission's proposal that follows EIOPA's opinion to enhance proportionality principle and relieve low-risk insurance of certain requirements, together with a specific proportionality approach to insurance and reinsurance captives. However, it is also important that supervisors keep flexibility in assessing the risk profile of the undertakings. More automatism and simplifications shall not occur to the detriment of supervisory judgment. We'll have just after this keynote a session on Solvency II, so I will not extend myself here. And I would like to conclude. Resilience of the insurance sector is essential for consumer confidence, consumer protection, and financial stability. The challenges are many and in constant change. This makes dialogue and cooperation between peers crucial, like we are doing here today, between you, with competent authorities at national level, at European level, and even at worldwide level. To conclude, I will end as I started, and I repeat that I'm very honored to be here, being part of this open and ongoing dialogue, and hope to leave tomorrow with a better understanding of your reality, of your challenges, but as well with a clear view on concrete steps on how we can translate these into concrete actions to better embrace resilience in the future. Thank you very much for your attention.
Dear Anna Teresa, I thank you very much for your presentation and your speech. And I would like to add one remark, which is obviously not typical for our keynote speakers. Anna Teresa will join us throughout this ECF and also participate in some of the other sessions. And she is prepared to listen to what we are doing, what kind of complaints, sorrows, problems we face, and we'll take that back home to discuss with her colleagues in EIOPA to improve the solutions which have to be prepared for captives and reinsurance captives. That's the first time, and I very much appreciate that EIOPA are interested to get part of our learning process. And we also would like to invite, or we have done that in the past, that some other supervisors, local supervisors, will help us understanding what we need to do, where we want to have changes or adjustments done. And today we are here with the next session, some supervisors from, and I will name them immediately, to talk about from Vermont, Oklahoma, Malta, and last but not least, Luxembourg. And we will discuss some of these topics which have been raised by Anna Teresa with regard to resilience, with regard to protection gaps and sustainability. So all these terms which are now discussed in the public, even we don't have an adoption of the review by the Parliament, which we expect, I don't know when. Politicians sometimes are slow, we know that, so everybody's beating on them. We do that now as well. Please, may I ask the panelists for the next session to come on the stage.
So I guess we sit right in front of ours. Ah, my mic is on. My mic is on. This one. So we have no. US banding together.
May I just introduce in the alphabetic order Sandy Beagleson as Deputy Commissioner, Captive Insurance, Vermont Department of Financial Regulation. Second to the right of me. Then next is Steve Kenyon, Captive Director, Insurance Department of Oklahoma. Just since how many weeks or days, Steve?
Couple days.
Last week.
Since last week. Anna Teresa Moutinho, you know her from the speech. Alfred Panis, Deputy Head, Insurance and Pension Supervision of the Malta Financial Services Authority. And again, last but not least, Valerie Schepas. She is Head of Non-Life and Reinsurance Department of the Commissariat aux Assurances. I would like to start with some statements of Anna Teresa with regard to especially the points on proportionality for captives. And then afterwards we come to the one or the other specific point and with the opportunity for all our colleagues also to compare between the European regulation and the requirements in US, in Vermont or in Oklahoma, as well as we will get a statement which the NAIC has prepared for future activities by Steve. So Anna Teresa, please, when you start.
Thank you. So again, I will start with Solvency II and take you through Solvency II review. And starting where I was saying on the keynote, today Solvency II in reality recognizes the specificity of the business model. There is one recital, but the truth is that then it does not translate into concrete rules. So it has a couple of simplifications on Pillar 1 calculations, but that's it, which meant that in Pillar 2, where some flexibility, this led to different implementations in different members. And even in Pillar 3, even the flexibility is lower, we also have the possibility to exempt from quarterly and to have some limitations at the annual reporting. But what we have observed is that not many NCAs use it. Around 11 across Europe use this possibility. And also the ones that use it, with some exceptions, they don't focus on captives business for the use of these powers. So that's why when Solvency II review started some years ago, we at EIOPA believed that it was the right time, and actually we also tried before, but it was the right time to try to address the real specificities of captives. And that's why, in our opinion, during our discussions, we tried to reflect a different approach towards proportionality in general and towards captives. And what we have in our opinion, which was then take over mostly from the Commission, it's actually 3 areas. So Article 4, a revision of Article 4. Article 4, it's proportionality, but for me it's different because, of course, leads to exemption from Solvency II, and in there we will see a revision of the thresholds. This might mean that some of the captives are being excluded, but again, I don't think this is specific of captives. We have then the general approach on proportionality, where companies can be classified as low-risk profile undertakings if they comply with certain criteria. But we thought that that would not be enough for captives, and we wanted to propose a specific proportionate approach to captives. And that's why we have proposed it, and it's now included in the Solvency II review. That for captives, we have additional simplifications on the Pillar 2, namely on the ORSA. So the ORSA should be done only every 2 years, and we will also have a reduced scope of the ORSA. So we want to be reflected in the delegated regulation after the discussion of the directive, the key points that an ORSA for a captive should focus on. So we have these 2 approaches for the ORSA, frequency, but also the content. Also, we had many simplifications on the reporting and on the disclosure area. On the reporting, we believe that from a quarterly reporting, list of assets and list of derivatives don't need to be reported quarterly for captives. From an annual perspective, we believe that all the details on the currency, because this can be actually very relevant for captives and lead to complexity in terms of reporting. We also believe that there should be an exemption on all the splits by currency, and this is reflected in a number of templates across the package, and also no variation analysis templates. So this actually leads us to a very significant simplification on the annual reporting package as well for captives. From the disclosure, I'm not sure if you know, but we also proposed a split of the SFCR, of the Solvency and Financial Condition report. Today it's 1 single report, and we proposed the division in 2, one aiming policyholders and other aiming professional readers. And there, what we propose is that for policyholders, captives only need to do it if they have natural persons involved in their business, but for the professional readers, the SFCR should be only the quantitative reporting templates, so no narrative part. And this, we believe, it's a big simplification as well. On top, we have additional simplifications for reinsurance captives only, namely on the reporting of the annual templates. Now, as I said, Commission took most of our proposals into the proposal, Council kept them. European Parliament is now discussing, but actually the discussions are going in the direction of recognizing actually the specificities of the captive business, so they are going in the good direction. There is even a question if captives should be classified as low-risk profile companies without needing to comply with any criteria. And the question I would like to bring here today as well for clarity is, does it matter if they are classified as low-risk profile? Because if we compare the benefits in terms of simplifications that the low-risk undertakings have with the ones that we propose and that are reflected in the proposals for captives, it's actually not better. So for reporting, for example, we propose that captives are exempted in quarterly. For the low-risk profile, NCAs shall assess if they should be exempted, for example. So it's not for sure that there is an exemption. If you look for the ORSA, frequency is the same, will be the same, 2 years, but there's nothing on the content, while for captives we have also proposals on content. On disclosure, for example, also very important. We propose that the SFCR should be the QRT only. Low-risk profile undertakings will have that, but every 3 years they need to publish the narrative part as well. And we don't have that in the proposal for captives. So in a nutshell, it will only matter if the captives do not comply with the criteria that we have included for the captives' use of simplifications. And these are immaterial part of business affecting natural persons and not covering compulsory third-party liability. And in fact, if captives do not comply with these two criteria, then it matters the classification as low-risk profile. I'm almost at the end. So if it does matter the classification of low-risk profile, also there we try to reflect the specificities of the captives, because there are 5, 6 criteria, depending if you read for live and non-live, but only also out of these criteria, we believe that there are 2, which is the cross-border business and the reinsurance business, which captives should be exempted. So even if you don't comply with the cross-border criteria or the reinsurance criteria, you can still be applied to low-risk profile undertakings. So in a nutshell, monitoring of the discussions, it's important, of course, we need to know the final package, but for sure, a very good, in my view, of course, proportionality package for captives will be reflected in the Solvency II review final text. And with this, I will like to hand over them. I hope it was clear.
Thank you very much. May I kindly ask the audience, if when you have questions, please can we raise your questions at the end of the various statements and comments on the panel. So then I would start or continue with some views from the US and ask Sandy, under US captive regulation, how do you determine a capital level as right-sized for its operations?
Thank you for that question. And this might help kind of compare and contrast US regulation of captives. And I think simply from a US regulatory approach, proportionality is really the essence of how we regulate our captives. Every jurisdiction has what's called minimum capital and surplus in insurance laws or captive insurance laws, and that is a minimum for solvency requirements. So it only becomes significant if a captive or an insurance company is trending toward insolvency, and that if they fall below that threshold, it's triggered. So the right size of a captive's capital and surplus has to take into account, there needs to be a component of risk capital. And how do we determine that? Well, there is a requirement through the National Association of Insurance Commissioners to calculate risk-based capital for some captive insurers, primarily group captives or captives reinsuring life policies of major carriers of life and health insurers. And the risk-based capital is really just a calculation to determine where a company should be at based on its asset and underwriting risks. We do have the discretion and the flexibility in captive insurance regulation to apply RBC or use it as a tool as we see fit. But for the typical, say, single-parent captive, how do you determine to right-size the captive and monitor the captive based on a healthy capital and surplus level? Well, you have to take into consideration stress scenarios. How will the captive perform? And this is where projections come in very handy. How will the captive perform? How is it intended to perform? And under certain stress scenarios, interest rate environments, market conditions, so on and so forth. So the calculation needs to take into consideration also structure. Is it a single-parent captive versus a group captive? If it's a single-parent captive, we absolutely have the ability and the intent to take a holistic view of the parent company, the ownership structure, and how the parent company can assist in propping the captive back up if things are trending negatively and the captive needs to be recapitalized. That is absolutely part of our job as regulators in the US to assess the financial health of the owners. We ask the question often, what can go wrong and what will be the plan if something were to go wrong, and how will you handle that? A captive should be viewed as a long-term solution for its owners. So capital, again, that holistic view is very, very handy. Volatility is another measure that we look at. Not one captive is the same as the other. You could have high frequency, low severity lines of business in a captive, and the opposite in another, or a mix of both in one. And you need to consider the volatility of those lines of coverage in assessing how much capital and how much risk capital is needed in the captive. A very, a minor error in a hospital that owns a captive could, a lawsuit for a minor error could turn into a multi-million-dollar claim. And those are some of the situations we need to be aware of.
So it is correct to say there is no common denominator of quantification process as under Solvency II Pillar 1?
That's right. Well, we do assess each captive. We have a famous saying in Vermont, you've seen one captive, you've seen one captive. So it is proportional to each. Our analysts and our examiners are skilled at analyzing each captive. Leverage ratios is another measure. Oftentimes we look at a healthy leverage ratio of reserves to surplus of 3-to-1. That means if there's a 10% increase in losses, that's a 30% hit to a captive's surplus.
Steve, you want to comment?
Am I on? Hello?
You should be on.
Hello, go ahead.
Borrow yours.
Go ahead. He is the one who is operating everything.
Hello? I would like to speak. Thank you. Okay. So Sandy's right. Yes, we don't, it's a state-by-state basis for captive insurance companies in the United States, but we don't have one benefit you have here in Europe, which is passporting for captives, right? So it comes with both good and bad.
So what are the other governance requirements and best practices which are imposed? Or also the question, how do you assess the risks of the captive's investment portfolio? We come later to that also with Valerie and Alfred.
Yeah, I think that was one of the questions that you had is how do you assess, concentration risk in a captive's investment portfolio? For the most part, captives have investment strategies and they have investment policies. Broadly, we assess how they are intending to manage their portfolio and invest their premium dollars. Concentration isn't necessarily too much of an issue. I think we find that their investments are relatively simple. There can be complex investment strategies during an examination or an analysis of reported financials. We often compare how they're addressing liquidity and diversity and how they have the ability to pay their claims. So, broadly, we are monitoring. We do have the ability, again, through regulatory discretion in our laws and regulations to apply certain investment limitations. And those are very prescribed limitations by traditional insurance law.
Yes, and this is important also for us, and also after the review, to be honest, because in terms of concentration, of course, there's impact on the market risk and the SCR, but we also have the prudent person principle, and the prudent person principle is where we observe today with Solvency II, where there is some lack of supervisory convergence on how it is being handled and how it's being interpreted, considering the captives, and it will remain because the Solvency II review will not touch on prudent person principle. So this is definitely an area where we need to work from a supervisory convergence perspective with supervisors on how this concentration risk, if there is concentration risk in some of the portfolios of captives, how much it is accepted, and what can we do to mitigate some of the risks that implies to have this concentration.
Yep. Thank you for that. We do apply a prudent person principle for the most part, and our investment limitation laws are kind of a proxy for that prudent person principle. And in governing the captive, we expect that the board of directors will set some goals and monitor the strategies not only over investments, but underwriting, pricing, how they handle their losses, whether they do it themselves or they rely on service providers. The governing board of a captive needs to be engaged. They need to have qualifications to actually sit on the board. And so those are some of the assessments that we make, is how is the captive being governed, and is it effective? Those are some assessments from the top down that we approach in our risk-focused approach.
Therefore, I would like to ask also Alfred and Valerie, how are intergroup loans considered for insurance undertakings and captives, in your case, by the MFSA?
Okay, first of all, we all need to realize that captives are insurance companies, and the EU rules apply to captives as they apply also to other insurance companies. So the prudent principle applies to them also. We all know that captives also love, actually, intragroup loans. So in 2016, towards the end of 2016, the MFSA had taken a decision to set up some rules around intragroup loans, because we were getting a lot of requests for intragroup loans. And they're set in one of our annexes to our rules. So essentially what we require is that whenever there's a captive or any other insurance company essentially wants to enter into an intergroup loan, they need to come for approval at the MFSA. So this is something which we wanted to ensure that when they enter into these loans, the companies follow some specific rules, and so that we could have some certainty. Also, they need to be backed by an agreement, and we also wanted to ensure that this would not lead to any double gearing. We don't want capital moving out of the insurance company or the captive to be used to set up another regulated entity. They need also to have a minimum rate of interest, and they need to be subject to a prescribed definite period. They cannot be open-ended, actually. There needs to be a clear repayment program. And also, we want that in the case that where there are dividends being paid, they will also be reduced from the intragroup loan. Also, in certain cases, there could be instances where they include in the intergroup loan agreement that large claims are deducted directly from the intragroup loan. For captives, it's quite open-ended, and we don't have a lot of rules on the counterparty. But for other insurance companies, we want to ensure that they are properly rated. So if there's no rating, we won't allow intragroup loans. Also, where there aren't any ratings, we would want to ensure that the audit report is a clean audit report of the counterparty, and that the gearing ratios and current ratios are of an acceptable level.
Asking Valerie, do you have a different view from the CAA perspective about intragroup loans and also cash pooling?
So not that much indeed. So it is clear that at the CAA we are very careful when it goes to intragroup loans and cash pooling. And the reason why is that if you look back at the history of the captive in Luxembourg, the only very few issues that we had with captive is in case of overexposure to intragroup asset. It never came from an underestimation of technical provision. An unexpected claim, the equalization provision which was not sufficient. It was never the issue. The issue was always an overexposure to intragroup asset. So this is a reason why we need to be very careful. And when we meet a candidate, a group that wants to establish a captive in Luxembourg, we make always our rules very clear. So we talk to everybody. We are keen in understanding your needs and the specific environment in which you operate, and that you need, to some extent, a certain allowance in that respect. But these are our boundaries, and you need to respect that. And we ask a written commitment on that as well. So we are very, very careful about that. What we did also last year is that we worked with the AGR, so this is the Association of Captive Managers in Luxembourg, and we work with them to have a common understanding on how these pooling and loans should be reflected in the standard formula. It's not always evident, and we worked with them to find a common view, and so that everybody is calculating this exposure in the same way. So there is no arbitrage in that respect anymore. So to summarize, quite close to what Alfred already said, so yes, we want to understand the specific environment in which a captive operates. There is a certain allowance that we can grant to intragroup asset, but we need to be careful, and we have some boundaries, and companies need to respect them.
With regard to the topic sustainability, which has been mentioned by Teresa beforehand, is that from your perspective an important topic for captives as well? A little bit different to, let me say, the professional insurance carriers?
Yes, it is. So once again, Thierry told you at the beginning that at the moment we are meeting candidates to open a captive. So this is a season, we see them in autumn, we see them in the winter. But I can tell you that all the industrial groups that we have met, they discuss with us about sustainability. And it is important for them to explain to us how they tackle this issue and all the kind of things that they are doing to try to reduce their carbon footprint on the environment. And we see so many different initiatives, like optimizing the transportation of goods, like changing the production cycle, really trying to have an impact so that they can reduce their carbon footprint. And this is important because what Teresa said at the beginning is that we have no choice anymore. We have to, all of us, we have to make these efforts and to go into the same direction. And this is what we see on the ground with them. And now to come back on the regulatory expectation in that respect. So we published several weeks ago an information note to explain to the market everything which is coming or which is already there in the legislation and where they have a touch of sustainability indeed. So you have so many things in the disclosure, in the ORSA, in the governance, and so on. And what is important to understand is that it's not like a kind of additional regulatory reporting requirement. It is an absolute thing that you need to do. And if I take an example, this is the inclusion of sustainability in the underwriting strategy and the thinking about climate change in the underwriting strategy. We met one candidate who explained to us that they have They have some infrastructures close to a river, and they were heavily touched by several floods. And they were thinking, okay, it's not normal, it never happened in the past. So we see that coming always more and more. And so with them, we spoke about, not about loss, not about technical provision on claims, but about prevention and what they can do to prevent the risk and to foresee that in the future they may be even more impacted by this kind of recurrent event than in the past, and that they need to adapt to that. And of course, they create a captive, but the captive is created with this consideration in mind. So it's not just a regulatory requirement. This is something that we see on the ground, that companies are doing and that can have an added value for them, because it can bring a value to them.
Yeah, EIOPA started with the Sustainable Finance Initiative, and may I ask Alfred to point out some of these topics which are of interest from your perspective?
Okay, I think sustainable finance activities, in particular, they're a step for Europe to achieve its goal for the European Green Deal. It's a long-term process, and this is a journey. It isn't something that can be carried out within a few years. But anyway, EIOPA has set some priorities, and they've set actually seven priorities, which I can actually read out. So, yeah. So
for those who want to read that in more detail, they have access via the EIOPA website.
Yes. So they're asking for insurers to integrate ESG risks in their prudential framework and consolidate the macro-micro prudential risk assessment of ESG risks, to promote sustainability disclosures, to support supervision of ESG risks and supervisory conversions in the EU, address protection gaps, promote the use of open source modeling and data in relation to climate change risks, and contribute to international convergence for the assessment and management of sustainability of risks. From our part, as a jurisdiction in Malta, we've very recently, 2 weeks ago actually, issued also one of these Dear CEO letters to our market, where we had issued also a circular where we clarified that the FSA expects insurance undertakings to update their policies, to start this process that's being suggested and required by EIOPA, and have the set policies approved by the Board of Directors in line with delegated regulations, and ensure that the documents are ready available for the MFSA upon request. Also, we are planning from next year to engage with our undertakings on a risk-based approach to assess their compliance with the new sustainable requirements and obtain a better understanding of their plans as to how they are and will continue to transition to this green economy.
When I've read some of these, or all the 7 points, I thought by myself that most of that, a prudent merchant will anyway consider things like that and act on behalf of his own interest. You know, this is not just the interest for short term, but long term. So one of the questions, for example, is the protection gap. I understand protection gap is a topic for EIOPA, primarily on the private lines issue. You mentioned 35% are insured when we have cat-nat events. And the big corporates usually know which kind of risks they carry by themselves. And then they have to not only to identify that and to assess the value at risk, but then they have to look how to manage that and how to pre and post finance it. But this is, I think, not the function of EIOPA or local supervisor to check now whether the various multinationals are able to identify their own, let me say, high-risk exposures and how to protect them. It's primarily small, medium-sized enterprises and I think the private lines business.
If I may, just a couple of points on everything what was said, because I think it's very interesting. I think 2 points I would like to highlight. One, on these new risks, we call it emerging risks, being sustainability or cyber, prevention of the risks is crucial. And prevention of risk is part of a shared resilience solution in any case. We are talking about risks that will not be able to, the insurance market will not be able to cover all of them. We will need a solution in the future. I mean, which role it is, it's true, it's not for EIOPA, it's really a worldwide cooperation that we'll need to solve that, but prevention of risks is absolutely crucial, and the insurance companies are increasing their role on advising the clients, and of course for captives it's even more close relation in terms of prevention of risks. The second point is that we should not think about this as well only as new risks. We should not think about new sustainability risks, because of course physical risk is important, transition risk is important, but more important is the impact on the risks we know of the climate change, of sustainability factors, of social factors, and that can be underwriting risk, can be market risk, can be any risk. And I think we need to rethink how we look at those risks, rethink our metrics, rethink how we assess them, because they will be impacted by these changes as well. So I think this is something, and that's why it's good news that we have now climate change scenarios on the ORSA, for example, because that will force companies to actually think on the impact on all risks of the company. So I would like to say these 2 words. On protection gaps, I mean, it's something that we have seen in pandemic. Clearly, on business interruption, for example, it's something that we are seeing on cyber risk, because the coverage opportunities are not there for everyone that wants to look for coverage, and for sure on sustainability as well. So it's something that we as a society need to think about, how we want to proceed on protection gaps, and the EIOPA is doing a lot of work on that area.
You are usually responsible for the insurance market.
Yep.
But when I started first time with Basel II and the banking system, and then followed by Solvency II for the insurance system, I asked myself what will happen next. So when we look on the protection gaps, we may raise the question, is it necessary that each and every multinational or each and every corporate is trying to assess their risk, identifying, assessing, and calculating their risks and how to manage whatever may happen in the future on the operation risk side, also claims raised and so on. So would this mean that each and every corporate has to do something similar to what the banks and the insurance sector have to do to become more aware of their risk structure and especially the volume of potential events which harm their activity and which may cause perhaps bankruptcy at the end of the day?
Yeah, I think that depends on the risk and that depends on the sector. If you think about cyber, for example, you have now an NIS directive that requires infrastructure to think about their cyber risk and then to mitigate it. It might be insurance, it might not be insurance. Actually, ENISA is now doing a report on how insurance is being used as risk mitigant by these operators of essential services covered by the NIS. Insurance is not only the solution. We need to look to the full picture. But we as regulators need to find our own role. It's true, and that will depend. But the regulation will do their job. We have the NIS on cyber. We also have a Cyber Resilience Act, which is now, I think, closer to adoption already. That is going to the economy, to the people, to the small businesses, and that will lead to new needs on insurance coverage, and we need to be ready for that, and we need to understand if the market is ready for that, and then we need to play our role, because if it's not ready, then we need all of us to discuss what we can do on shared resilience solutions and this cooperation between private and public, because it will be needed in the future.
But I would like to reduce the expectations that catastrophic risks such as a pandemic or, let me say, internet breakdown, not just a little bit, overall, can be paid and remedied by either the insurance market or the governments. That's a threat to the entire economy, and so we should not believe that we can pay for everything because before you pay, you have to pay either premium or taxes or something like that. Otherwise, there are no funds, you know. And so we have to be realistic. What is possible and what is, let me say, is fate.
Exactly. We are all agreeing, I think.
Yeah.
That's exactly why we have developed our shared resilience solution framework. A shared resilience solution framework exists because we acknowledge that it's not possible for the insurance market to cover all risks. That's why you need to work on risk prevention to reduce that risk, and that is a role for everyone. And then we need to think at the end, if it gets to a systemic event, what will be the solution? And there for sure will need to be a public-private kind of solution that we don't have today at a worldwide or European level. We have some solutions developed in different countries that is already covering. Spain already has a consortium covering cyber risk, for example. And this is the type of things that we at EIOPA believe we should study and continue to promote the discussion, because again, the solution doesn't lie with us, doesn't lie with the industry, but in a joint cooperation between stakeholders.
From a US perspective, please.
Yeah, our regulatory practices really should include, and do include, the development of practices that constantly assess risk, prospective risks, alongside the companies that own the captives. They are having to identify and address these risks, whether it's ESG, around resiliency. We are seeing disclosures, we're paying attention, how it will not only impact the owners of the captives, but how they will impact the captive going forward. It's quite possible, and I've seen it happen, where a captive outlives its parent company because the parent company goes under, and the captive survives and can pay its losses and then go away. We are seeing solutions in terms of cyber, pandemic, weather events, solutions that utilize parametric contracts or parametric triggers within an insurance policy. Those are just some of the
I think this
thoughts.
is, for US, it's even more stressing when we see now in Florida the uninsurability for weather events. So are the NAIC or the regulators involved in considerations how to react on that, comparable to EIOPA's activity here?
So, Gunther, and for Florida, as you mentioned, there are very large difficulties in obtaining insurance, especially for property now. And Florida is expecting another hurricane as we sit here right now, right? So that hurricane will affect Florida the next few days. But to your comment and Anna's comment a moment ago, I mean, certain risks that are uninsurable. Remember 9/11 and the terrorism risk that we faced after that, and how both industry and government responded, at least the United States, with the Terrorism Risk Insurance Act. We have Pool Re in the United Kingdom. So there are ways to address that, of course, with limitations and certain levels, what I call deductibles, before the government portion of the government payout will pay. Now, whether that will occur with I want to say parametric because I can get to that in a minute, but with pandemic risk, another word that begins with a P, we'll see. Studies have been undertaken. Bills were before the U.S. Congress in terms of how to address pandemic risks, and none of that has come into effect yet. So all of these ideas about how to address things like pandemic risks remain ideas, but they can, as we have seen with terrorism, they can come to life.
There are a lot of topics and items we may discuss. Perhaps we can look onto the questions raised on the Slido. Once we have Slido, we have to use Slido. So may I ask, the first question I think is for Anna Teresa. Do you see AI assessment as part of also reporting by captives? Presumably most captives don't rely on AI in their business activity. And I think this is reasonable, to be honest.
Yes, I can address that. I mean, for sure, if the companies that don't rely on AI on their business activity don't need to do anything. The question is when AI is used, and to be honest, I don't think that's probably the case of captives, but many companies use, of course, data on customers to assess risks, to define pricing, and this can be risk-related, can also be non-risk related, which is a different issue. So I think that in case of the AI, yes, it does cover insurance business. I don't think, unless of course there are specific cases on specific captives, it is an issue for you. Also because the discussions we are having and that we are observing on the AI Act, what is considered high risk, it's linked to fundamental rights of the person, so it's linked to insurance related to life and health. So I think that it will not impact very much you, and of course, if you don't use AI, there's no impact, of course.
Valerie, by definition, captives can't really choose risks underwritten because they look on their parent company. They may try to influence the parent to mitigate the risk in view of ESG, but then I don't know what he means with but.
Yes, this is correct. So a captive company cannot really choose the risk that it will take. Indeed, why is a captive most often created at the moment? Because of market hardening, because the prices are too high on the traditional market, because there is a kind of risk which is complicated to cover by the industrial market. So of course you end up with a pool of risk that you have not really chosen, and this is the role of the captive indeed, to offer like a kind of alternative capital to the traditional market. But then once the captive is set and you have a risk manager also at the captive, so it should also, as it is written, have an influence on the group indeed to mitigate the risk. And this is also one of the arguments that a group can use with the traditional market and saying, I have created a captive, so I have a capability to make a proper risk management because I have the capability to manage a reinsurance company. And so they can also try to better discuss, to better negotiate with the traditional market by adding this additional risk management capability to the scope of the capabilities that are already there within the group. So yes, you end up with the risk that the group has chosen for you, or that the group has some difficulties to place on the traditional market. But after you can have an impact on the group by making some analysis, providing analytics to the group, and helping to go into the right direction.
It's depending on how much the insurance part of an multinational is involved in the risk management assessment and activity advisory function.
Yes, exactly. But what we see, frankly speaking, what we see at the board level of our captive company, these are the very, very often the key person of the group. The financial function is very often there. The risk management function of the group is very often there. So we have usually at the board level of the captive company, we have a high seniority within the industrial group.
Perhaps we should require that always one member of the C-level is part of the board of a captive, then they have a direct interest in the activities of a captive, and they are better informed of what we are doing and why it is reasonable and why it is helpful and so on, So, recommendation. Sandy, for monoparental captives, usually we have monoparental captives. If it goes bankruptcy, only the parent would be affected. So at the end, supervision protects creditors of the parent.
Yeah, that's an interesting question, and I hope others pipe in. But in state insurance laws, there's receivership. There's receivership rights as part of a regulation, and there's a certain order of priority. Policyholder claims are pretty high priority for payment, so it does protect. But, with the first order of business in taking a company into receivership, in this case, because the parent is in bankruptcy, is to take ownership or seize the assets and decide what assets are there to pay the claims. And then you're in basically a liquidation or a runoff situation. We've had I don't know how many liquidation cases over the 41 years, relatively few. One high-profile one was Enron, and if folks remember back when that fiasco happened, we took the company into receivership. The parent, of course, was bankrupt. They had a significant loan back. We wrote that off, and there were enough assets to pay all of the claims, and it was a very successful liquidation scenario where money at the end went back to the estate of Enron. So we hope that is always the case, that there are successful liquidations and that there's A, money to pay the claims, and then whatever else is in line based on the priority. But B, that there's money left over to kind of pay who we need to, or maybe go back to the estate.
Steve?
Good points, Sandy, very good points. In the United States, insurance companies are not subject to the federal bankruptcy laws. And I'll say that again. Insurance companies, whether it's a captive or any of the insurance companies, are not subject to the federal bankruptcy laws.
Thank you.
So, you're welcome. So, that's a very important point because in certain types of insurance, and this is a segue for what Lorraine and Stack and I will be talking about later for directors and officers insurance, if your company is bankrupt in bankruptcy and your directors are sued and the captive insurer is providing directors and officers insurance, it's very important that that captive insurance company is not in the same bankruptcy proceeding as the parental company is. And as Sandy said, insurance companies are only, and I say again, only subject to the state insurance receivership laws, since we have a state-based regulatory system for insurance companies in the United States. However, I've said that in 2012, an Arizona domiciled captive insurance company was consumed in or sucked into the bankruptcy for its parent. Now, there are many reasons for that, primarily because no one objected to that occurring. The state did not object to that occurring. The regulator did not object, nor did the directors of the insurance company. So there has been an exception to that rule, but only one exception I know.
Interesting.
Yeah. The next question, I think, can be replied by either Anna, Teresa, or Steve. Will there ever be passporting for EU and USA to create a large insurance market? How do regulators view this? We know that there is a discussion since years about equivalency between EIOPA and the NAIC. Please.
I don't follow closely. I mean, we do have the EU-US agreement that entered into force now in September. So I think this is a very important step. I don't know if it goes to passporting, but it's definitely a very important step that it's just being implementing. Mm-hmm. And that, of course, gives a freer market between EU and US. But I don't know the details of the agreement, to be honest. I don't know if the colleagues know.
Yes, Anna, that's maybe a first step. Maybe a first step has been taken with something called the covered agreement, where certain European reinsurers can provide reinsurance coverage for U.S. domiciled insurance companies for U.S. risks without collateral requirements. Okay? And there are the NEIC, National Association of Insurance Commissioners, maintains a list of jurisdictions such as France, Germany, Japan, amongst the United Kingdom, whose reinsurers who have certain ratings, such as AM Best ratings, can provide such reinsurance. And of course, it works the other way in terms of U.S. insurers providing reinsurance in the European market. However, it's mostly European reinsurers providing reinsurance in the U.S. market. The question is passporting. Will it come anytime soon? I don't think so. No.
I don't believe it.
So, ask me in 20 years when I come back to this conference, same question, and I will give you the same answer.
May I start with the third question to all panelists, because I think this is quite interesting for each and everybody who is also planning to establish a new captive. How long does it take for a captive application to be approved in your domicile? Have you added resources to meet increased activity? So where do we start from the?
Okay. Yes, it's in our law. It's very specific for captive applications. We have a maximum period of 3 months to consider an application.
A maximum for you to work on that.
Yes, yes, yes.
Yeah, that's good.
Yes. So it's entrenched in our laws. It also always depends also on the quality of the application. So the better the application, we've had applications that we've approved.
Rejected.
We've approved in a much shorter time also. So it depends on the level of the application, but maximum it's three months.
Yeah, so my comments really are, we aim for 30 days from a complete application. We have staff and resources. We have a licensing and analysis compliance staff. We have, once a captive is licensed, we have exam and analysis staff for ongoing monitoring. But so the resource question is a definite yes. So within the 30 days of a complete application, so we have certain application requirements, data, information that we collect. Feasibility is a centric part of that application. And in our review, we can tell that the majority of the work has happened for months, sometimes years, leading up to actually filing an application. And we can tell whether the data and the information is complete, it lines up, it aligns with what your actuary is recommending, what your accountants are recommending internally, that you have buy-in among your corporate C-suite. We do background checks of officers and directors. So we have a whole process and people to service that process. So typically, we ask for 30 days to receive a license.
Steve, do you have a similar?
Yes, as I began my new position in Oklahoma as a captive insurance director last week, after 13 years in Delaware. One of my missions of what I was brought to do was to develop a new licensing program, a new infrastructure to build a system so the state can provide better. It provides good captive insurance services now, but to provide better services. I mean, Oklahoma is an energy state. One of its focuses is to provide captive insurance coverage or allow energy companies, oil and gas, to form captives there, since it's becoming more difficult for those types of companies, those industries to find insurance coverage. And of course, they still need insurance coverage because we still rely on oil and gas and coal, whether we like it or not. So again, that's one of the reasons I was brought in, to build a new infrastructure for developing that into a captive domicile.
From a time perspective?
30 days. Yes.
30 days.
Yes.
Valerie, this is a challenge or not, 30 days?
30 days, I cannot make it. And I will not try to compete with Alfred. So 3 months is a reasonable time that you should expect indeed. So, but there is really a lot of dependency on the quality of the file that we receive, on the completeness on the file, and after we have sent a set of questions on the reactivity on your side, indeed, to come back to us. What we see on the ground is sometimes a difficulty to explain to an industrial group that they have also, that we have to make a fit and proper on the shareholder structure as well. And so that we need to know all the steps in the shareholder, and that these people needs to send ID, copy of ID, criminal records, and so on. So sometimes this is where it is most complicated to explain to a group which is not operating in the financial sector, that if they want to establish a captive, then they need to follow some rules that they are not very familiar with. So 3 months is a reasonable time period. Now, did we add some extra resources? Yes, I have the chance to head the non-life department and the reinsurance department, meaning that I can use my resources in a more flexible way, and then I know that at the end of the year I will allocate more people to the captive files, because this is a reality. This is each year the same, and so we, when we make the program, the working program at the beginning of the year, the on-site inspection, and so on, we know that at the end of the year we will not foresee a lot, because we will have this extra workload with the new files. So we can adapt to an increased workload, but once again, the quality of the file is a very important point for us to be sure that we can deliver a license in a reasonable time frame.
I recommend to all interested parties to use real professional services advisors to make it possible that the application period will be less than 3 months. And I'm pretty sure that it is a question of completeness and that everything is considered by the applicant and the advisor, and then it should be done rather quickly. But this is really the point. We should not start with bashing the supervisors. You are so slowly. No, it is a question of how much do we prepare our papers and present that in a professional way. And each and every captive owner has to perform afterwards anyway as a real professional and not someone who is just stepping in or out or whatever. So that's, I understand that it takes some time sometimes when...
Yeah, I think really it comes from a place of knowing who, getting to know the company, why they need a captive, why it's important, what's the insurance and risk financing and risk management needs. And it comes from a place, you get to a point where you understand who they're using as business partners, and it's a matter of trust, and then trust and but verify from a regulatory standpoint.
And maybe we don't approve, of course, we don't authorize captives, but I was looking one of the other questions on the limit access to data from the captive owner.
Yes.
And I think that the captive owner, when we are setting up a captive, it's important that they realize that they are setting a regulated entity and that the regulated entity needs to comply with some rules, and that implies also access to this data. And I think this is a very relevant role for regulators when approving the captives from the beginning. So I just wanted to add that because I was reading all the other questions and I thought it could be a nice quick win.
Yeah, is there any, one of the questions we should choose? Otherwise, we are rather close to the end of the session.
Maybe the last one, the proposed captive amendments, do they put a limit on intercompany loans? For the reinsurance captives, I think, simplifications, not for the insurance captives. There's nothing there. This is something we need to discuss under the prudent person principle. I think that for the reinsurance captives, to get the additional simplification, to have even less annual reporting, there is a limit, I think 20% of intergroup loans, if I'm not mistaken.
I always advise each and everybody that one of the basics in our Solvency II regime is comply or explain. And if you really believe it should be more than 20%, then you may be able to explain that so heavily and that the regulator, supervisor can't deny that you will do a little bit more than allowed. So I thank very much all of you, all the supervisors and our regulator in Europe, and wish you good luck for the next sessions you may participate or will listen to. And I hope the audience was happy with this session. Thank you very much.
Thank you.